As we head into the trading day on Friday, November 7, 2025, the U.S. markets are currently closed. Shares of Haemonetics Corporation, ticker HAE, finished yesterday's session in spectacular fashion. The stock closed at $67.19 per share, marking an explosive intraday gain of $16.47, or a staggering 32.47%. This wasn't just a mild positive reaction, it was a definitive, high-volume statement from the market, with the stock trading in a massive range from a low of $49.96 to a high of $67.88, ultimately closing near its peak for the day. For a stock that was recently languishing near its 52-week lows, this move is jarring and demands a serious look at what just happened, and more importantly, what it means for anyone holding this name in their portfolio, whether it's through Fidelity, a Robinhood account, or a managed solution like Schwab Intelligent Portfolios. The immediate trigger for this, as you've likely seen, was the company's latest quarterly earnings report, which hit the wire before the market opened on Thursday. But here is the fascinating part that most of the headlines are missing. The market completely ignored a significant negative data point. Haemonetics reported that its total revenue actually declined by 5.3% year-over-year. In this market environment, a top-line contraction like that is often a death sentence for a stock. We've seen stocks like Tesla stock and even Apple stock get punished for far less, for merely missing growth expectations, let alone shrinking. So the expectation heading into this print, especially given the stock's weak performance over the last year, was likely one of apprehension. The common belief was that Haemonetics was facing significant headwinds, with some analysts back in August trimming price targets, citing slowdowns in key product lines. The stage was set for disappointment. But then, reality intervened. What the market cared about wasn't the year-over-year comparison, which can be noisy. It cared about performance versus estimates. Haemonetics delivered an adjusted earnings per share of $1.27, which wasn't just a small beat, it crushed the analyst consensus estimate of $1.11 by over 14%. And that revenue figure? While down year-over-year, the $327.3 million it posted was still more than 5% clear of the $310.8 million Wall Street was looking for. This is a classic case of expectation versus reality. The expectation was for a continued struggle, for a company barely meeting lowered targets. The reality was a demonstration of massive operational efficiency and profitability. The company proved it can manage its costs and deliver bottom-line results even in a challenging sales environment. This tells you that management has a firm grip on the business, which is precisely what institutions want to see before they start building a position. This is the kind of data that professional traders using sophisticated platforms like interactive brokers look for. It's not just about the headline number, it's about the quality of the earnings and the message it sends. Yesterday's trading session was a technical marvel. The stock gapped up hard at the open and it never looked back. This wasn't a sell the news event. The volume was immense, clocking in at around 4 million shares, which absolutely dwarfs its average daily volume of roughly 1 million. This wasn't retail traders on the Robinhood app simply chasing momentum, though there was certainly some of that. This was institutional buying. This was big funds with Fidelity Wealth Management accounts deciding the bottom was in and the story had changed. When you see volume that is 4 times the average and the stock closes at the high of the day, it signals that the buyers were aggressive and absorbed every share that sellers offered all the way up to the closing bell. This kind of price action often suggests the beginning of a new trend, not just a one-day wonder. It signals a fundamental repricing of the asset. Many investors who practice self-investing might see this as a clear signal that the market's entire perception of HAE has been reset. Of course, this single-day surge, while impressive, has to be put in context. Before yesterday, HAE was a painful stock to own. It had traded as high as $94.99 within the last year, and just a few days ago, it was threatening to break below $50. This 32% jump, in reality, only crossed back a fraction of its longer-term losses. This is where the investment help comes in to separate the signal from the noise. The big question now is whether this earnings report is a true turning point or just a temporary relief rally in a longer-term downtrend. The bears will point to that 5.3% revenue decline as proof that the core business is still struggling. They'll argue that cost-cutting and efficiency gains can only boost earnings for so long. Eventually, you need to grow the top line. They will also point to the high 52-week range and say that even at $67, it's a long way from its former glory. Some may even be looking at this spike as a chance to initiate a short position through their Fidelity brokerage account. The bulls, however, now have a powerful new narrative. They can argue that the revenue decline was a temporary issue, perhaps related to divesting a business line or a tough comparison to a strong quarter last year, and that the beat on organic revenue, which the company highlighted, is the real story. They will focus on the company's margin expansion, which was significant. They will point to the plasma and hospital segments as drivers of this strength. Management's commentary on the earnings call was likely very confident, painting a picture of market share gains and durable demand for their blood and plasma collection technologies. This is the investment thesis compelling for many. It's a business with a wide moat, high switching costs, it's not easy for a hospital to rip out and replace its entire blood analysis system, and a recurring revenue stream from disposables. This is the kind of stable, long-term business model that many Fidelity mutual funds are built to hold. Looking forward, the landscape is now completely redefined. The immediate next test for HAE will be follow-through. Can the stock hold these gains? We need to watch the trading activity over the next few sessions. Will the stock consolidate around $67, building a new base of support? Or will it give back some of these gains as short-term profit takers cash out? The next major catalyst will be analyst reactions. After a beat this large, you can expect a flurry of upgrades and price target increases. The same analysts who were cautious before may now be racing to raise their targets to $75, $80, or even higher. Their reports will be crucial in shaping the new narrative for the stock. We also need to watch for any insider activity. If executives who just delivered this great quarter start buying shares on the open market, even after this run-up, it would be a huge vote of confidence. Conversely, if we see heavy selling, it might suggest they view this as a good exit point. This is the kind of information that active traders on platforms like SoFi Invest or Interactive Brokers monitor constantly. The risks, however, have not evaporated. The broader macroeconomic environment is still a concern. If hospital budgets tighten due to a recession, they might delay purchases of new equipment. The plasma collection market is also highly consolidated and competitive. Haemonetics relies on a few very large customers, and any change in those relationships could be a major blow. This is why a diversified approach, perhaps using Schwab Intelligent Portfolios or a selection of Fidelity ETFs, is often a prudent strategy rather than going all in on a single, volatile name like this one. And let's not forget the recent insider selling we saw, albeit small, back in September and early November before this report. Was that just routine, or did they not anticipate a report this strong? It's something to consider. For those using SoFi investing tools, setting alerts for this stock is probably a smart move. This brings us to the core of the issue for anyone considering an investment here. Was yesterday the start of a major recovery, or was it a one-time recalibration? The expectation was that HAE was a broken stock. The reality is it's a highly profitable company that just proved it can execute under pressure. The tension between these two ideas is where the opportunity and the risk lie. This is no longer a simple value play or a growth play. It's a turnaround story. And turnaround stories can generate massive returns, but they also carry high volatility. This is not a stock for someone who wants to just park their capital in an individual brokerage account and not look at it for 5 years. This is a name that will require active monitoring. The market has now priced in a much brighter future for Haemonetics. It's up to the company's management to deliver on that new, higher stakes expectation. The next few quarters will be critical. The company must prove that this quarter's profitability wasn't an anomaly and that it can return to sustainable top-line growth. For now, the momentum is squarely with the bulls. This 32% move has likely forced a massive short squeeze and reset the technical picture entirely. I'm very curious to see where the institutional money flows from here. This is a great example of why online investing is so